let's talk about what's really happening in your brain when you delay investing. Studies published in the Journal of Finance found something remarkable. Investors who experience failure develop negative expectations. These expectations create what psychologists call analysis paralysis. You overthink. You overanalyze. You research until you're drowning in information. But here's the brutal truth. All that analysis doesn't help. It hurts. Research from Jordan's International Journal of Information Research and Review studied investors struggling with uncertainty. They discovered that people who couldn't tolerate uncertainty fell into rumination loops. They kept examining the same questions over and over. Is now the right time? What if the market crashes tomorrow? Shouldn't I wait until things stabilize? These questions don't lead to answers. They lead to inaction, and inaction has a price tag. Charles Schwab's research team conducted a 20-year study. They tracked 5 different investors. Each received $2,000 at the start of every year. Investor 1 had perfect market timing. Impossible, but let's pretend. He invested at the absolute lowest point every single year. He ended with $151,391. Investor 2 invested immediately on the first trading day of each year. No timing, no strategy, just consistent action. She ended with $135,471. The difference? Just $15,920 over 20 years. Now here's where it gets interesting. Investor 5 kept waiting for the perfect moment. He held cash, watched the market, convinced himself that lower prices were just around the corner. He ended with just $44,438. The cost of waiting? $90,418. That's the price of trying to outsmart the market. Let me say that again. The cost of waiting is 6 times larger than the benefit of perfect timing. And perfect timing is impossible anyway. Research from Facet Financial studied investors with 40-year time horizons. They found something that should shake you awake. If you have $100,000 to invest today and you wait just 1 year, that delay costs you over $140,000 in lost growth. Wait 2 years? The cost jumps to $275,000. 3 years, nearly $400,000. These aren't theoretical numbers. This is compounding interest working against you instead of for you. Every month you wait, you're not just missing potential gains, you're missing gains on those gains, and gains on those gains. Time is the most powerful force in investing. But it only works if you actually invest. But the market's at all-time highs. I hear this constantly. Let me share something that'll change how you see this. Since 1950, the S&P 500 has hit over 1,250 all-time highs. That's an average of 16 new records every single year. Bradford Financial Center analyzed what happens after the market hits these peaks. 12 out of 13 times, the market was higher 1 year later. Average gain? 15.3%. 11 out of 13 times, the market was still up 2 years later. Average gain? 23%. Waiting for a correction means you'll miss most of the gains. Think about it this way: avoiding investment because prices are high is like refusing to buy gas because it costs more than it did last year. You might save a few dollars, but you're stuck on the side of the road while everyone else keeps driving. Here's what the research tells us works. Studies published in the Journal of Financial and Quantitative Analysis ran stochastic dominance tests. That's fancy language for we tested every possible scenario. Their conclusion? No risk-averse investor should choose a random active fund over a random index fund, ever. Let me break down what this means in plain English. Active fund managers, the experts with fancy degrees and expensive research teams, underperform simple index funds 97% of the time over 10 years after fees. 97%. Here's how simple this can be. Rice University professors Alan Crane and Kevin Crotty studied index fund performance. They found that the best index funds perform nearly as well as the best active funds, but they cost far less. More importantly, the worst index funds still beat the worst active funds, even before accounting for fees. You don't need to be smart. You don't need to be lucky. You just need to be consistent. Here's your 30-minute setup. Step 1. Open a low-cost brokerage account. Vanguard, Fidelity, or Schwab. Takes 15 minutes. Step 2. Choose one or two index funds. A total stock market index fund. Maybe a total bond market fund if you want stability. Step 3. Set up automatic monthly investments. Pick a date, pick an amount, let it run. That's it. You've now built a portfolio that'll outperform most professional investors, and it took you half an hour. Here's why automation is crucial. Research from multiple behavioral finance studies shows that emotions kill returns. Fear makes you sell at bottoms. Greed makes you buy at tops. You know what doesn't have emotions? Automation. Set up automatic monthly investments, and you never have to decide. You never have to think. You never have to face that moment of doubt when the market dips. The market drops 10%? Your automatic investment buys more shares at lower prices. The market jumps 15%? Your automatic investment keeps you in the game. You don't have to be smart. You don't have to be brave. You just have to start. Studies compiled in the journal Emerald Insight examined passive investing across 943 peer-reviewed articles. They found consistent evidence that index funds deliver superior risk-adjusted returns. Why? 3 reasons. First, lower fees. Active funds charge 1 to 3% annually. Index funds charge 0, 0, 3, 0, 2%. That difference compounds brutally over decades. Second, lower taxes. Index funds trade less frequently. Less trading means fewer taxable events. You keep more of what you earn. Third, behavioral protection. When you own an index fund, you can't panic sell individual stocks. You own the whole market. The whole market recovers. Always has. But what if I invest right before a crash? Great question. Let's look at the data. Charles Schwab studied the investor who had the worst possible timing. This person invested at the absolute peak before every major crash. 2000 dot-com bubble, 2008 financial crisis, 2020 pandemic crash. Worst timing possible. Every single time. That investor still ended up with more money than the person who stayed in cash waiting for the right moment. Here's why. Time in the market beats timing the market. Even if you invest at peaks, you're still in the market when it recovers. And it always recovers. The person sitting in cash, they miss the recovery entirely. They wait for the perfect entry point that never comes. Let me paint you a picture. You're 52 years old. You want to retire at 65. That's 13 years. If you invest $500 per month in a low-cost index fund averaging 8% annually, you'll have roughly $111,000 by retirement. Not life-changing. But it's $111,000 more than you have now. Now let's say you wait. The market's too high. I'll start when it corrects. You wait 2 years. Same $500 monthly investment. Same 8% return. But now you only have 11 years. Your ending balance, about $94,500. That 2-year delay cost you $16,500. And that's assuming you actually start after 2 years. Most people who wait keep waiting. Studies from the National Bureau of Economic Research examined the value of waiting to invest. Their findings were stark. The longer you wait, the more exponentially you lose. It's not linear, it's exponential. Every day you delay, you lose not just today's potential gains, you lose tomorrow's gains on today's gains, and next year's gains on tomorrow's gains on today's gains. Compound interest works both ways. It can build wealth or destroy opportunity. The choice is yours. Research published in behavioral finance journals identifies specific techniques to overcome analysis paralysis. Technique 1, set a deadline. Give yourself 72 hours to make the decision. Not 72 days, not 72 weeks, 3 days. Technique 2, limit your options. Don't research 50 funds. Pick one total market index fund. Done. Technique 3, start small. Can't commit $500 monthly. Start with $100. Start with $50. Just start. Technique 4, automate immediately. The moment you open the account, set up automatic investments. Remove the decision from your future self. Here's something most people get backwards. They think investing is risky and sitting in cash is safe. But research from Wharton's Investment Strategies program shows the opposite is true for long-term investors. Over any 20-year period since 1926, stocks have never lost money. Never. But inflation? Inflation destroys cash every single year. Your safe cash savings are losing 3% annually to inflation. That's guaranteed loss. Your risky stock investment has historically gained 10% annually over long periods. That's historical gain, which is actually riskier. I want you to imagine something. It's 13 years from now. You're ready to retire. You look at your account balance. It's substantial. Not because you got lucky, not because you timed anything perfectly, because you started, because you automated, because you let time do the work. Or imagine the alternative. You're 13 years older, still working, still waiting, still convinced that the right time is just around the corner. Which version of yourself do you want to be? Here's what you're going to do today. Within the next hour, research 3 brokerage firms: Vanguard, Fidelity, Schwab. Read reviews. Pick one. Within 24 hours, open the account. It's online. It's simple. It takes 15 minutes. Within 48 hours, fund the account with your first investment. Doesn't matter how much, $100, $500, $1,000, whatever you can afford. Within 72 hours, choose one low-cost total market index fund. Set up automatic monthly investments. That's it. 4 steps, 3 days. One decision that changes everything. Studies from Cambridge, Wharton, Rice University, Charles Schwab, and dozens of peer-reviewed journals all point to the same conclusion. The best time to invest was yesterday. The second best time is today. Waiting costs you more than any market correction ever could. Analysis paralysis destroys more wealth than market crashes. Fear of making the wrong choice keeps you from making the right choice. My uncle finally invested in 2019. 4 years too late. He's still working at 65. Not because he wants to, but because he has to. He tells everyone who'll listen, "Don't make my mistake. The market wasn't too high in 2015. He was just too scared. Fear is expensive. Action is cheap. You already know what you need to do. You've known it for months, maybe years. The research is clear. The path is simple. The tools are available. All that's missing is your decision to start. So stop waiting for the perfect moment. It doesn't exist. Start building your low-effort portfolio today. Set it. Forget it. Let it grow. Your future self is counting on the decision you make right now. Don't let them down.